Recent studies suggest that as much as $1.3 trillion in excess cash, over and above the level required for efficient business operation, is trapped in the balance sheets of companies globally. Against this backdrop, many of our corporate clients are looking beyond traditional financing approaches to a range of alternative funding structures designed to enhance balance sheet efficiency and optimise capital outcomes. Corporate treasury teams are strategically focused on positioning their balance sheets to derive maximum efficiency, freeing up trapped cash, and extracting liquidity through working capital management improvements. Financing strategies can be key in accelerating the cash conversion cycle, releasing liquidity, and reducing reliance on external debt funding. Funding quality has become a competitive differentiator within industries, and working capital optimisation is a critical enabler for value creation. Capital-efficient businesses are better placed to fund growth and more resilient in the face of market volatility, scarcer liquidity, and increases in funding costs. We're seeing intensified focus on asset financing strategies. Our clients are examining a number of alternative leasing approaches, both operating leases structured to achieve off-balance sheet treatment, and finance leases that remain recognised on balance sheet, undertaken to realise pricing advantages, accomplish financing syndication, or manage other commercial imperatives. Structured leasing arrangements and sale and leaseback transactions are tailored to maximise value from the relevant assets while allowing the corporate lessee to retain operational flexibility and to release capital from the corporate's balance sheet. Structured and syndicated leasing transactions also offer funding flexibility while facilitating access to alternative sources of capital. We're also seeing structured debt technologies being employed by corporates outside the traditional securitization space. Once seen as a specialist financing tool for consumer and trade receivables, securitization is increasingly recognised as an opportunistic funding technique. In recent years, we've advised clients on a number of innovative structured debt financings involving non-traditional securitization issuers and non-traditional securitization asset classes. In the acquisition context, securitization finance facilitates greater transaction optionality, potentially allowing a corporate or private equity sponsor to participate in larger transactions without relying on its own balance sheet for the debt component of the funding package. Instead, lenders fund against the value of a portfolio of assets up to a certain advance rate, with the bidder funding the remainder of the capital required. In addition to higher debt volumes, lower funding costs, longer tenors, and more favourable covenant terms than traditional finance avenues are additional advantages. We're also seeing corporate treasurers, as part of a vigilant approach to managing cash and minimising risk, looking at securitization and other financing techniques to monetize accounts receivable, to enhance supply chain arrangements, and to optimize inventory management. On the sell side, trade receivables securitization enables a company with highly rated customers to release liquidity from its accounts receivable by reducing its accounts receivable days outstanding. Particularly in the case of a sub-investment grade corporate, trade receivables securitization facilitates access to reduced funding costs and diversified funding sources by separating the accounts receivable debt owing to the company from the company's own credit rating. On the buy side, supply chain finance arrangements allow strong corporates to leverage their better credit rating to support their suppliers while extending their own payment terms. Supply chain finance programs employ the collateral of outstanding debt owed by a strong corporate to offer cash flow advances and thus improve liquidity to the company's suppliers at competitive pricing. Ultimately, companies that fail to maximise balance sheet efficiency and optimise working capital not only miss opportunities to free up cash for investment, but also forgo the chance to boost their return on capital and enhance shareholder value. There is obviously no one-size-fits-all solution. Innovative financing platforms structured to increase balance sheet efficiency optimise working capital management and enhance liquidity are necessarily tailored to accommodate the particular features of a company's business operations and industry context. But the opportunities for value creation afforded through operationally efficient, tailored solutions are significant.